Hello, everyone. So now we are in topic two, processing financial data. And this is me once again, Gurpinder Gill, your instructor for Accounting 315. So, topic two, processing financial information. So, our learning objectives here is that we will be looking at accounting transactions. We'll talk about the adjusting entries. We will be looking at trial balances, adjusted trial balances, post closing trial balances, preparing financial statements, closing entries, and adjusted trial balances. So, just a quick reminder before we get into the details of topic two. Topic two, as I had said in the last recording, so topic one and topic two, both of these topics are primarily a refresher of your prerequisite courses. There is no new material here. Um, but it's more of just to get our feet wet, just to get things started. So it's more of a refresher than anything. If you have any questions or concerns, so either let me know, or you might want to go back to your prior accounting courses, those materials, and refer to details on these transactions. Our current textbook that we are using also serves as a great resource. So let's jump right into it. So this is what our accounting information system looks like. So the accounting information system basically is the way to collect the financial information, to process that, and to spit out the financial statements at the end. Okay. Now there are different types of journals, such as your cash journals, your receipts, your disbursements. There are sales journals. Okay, but when we are looking at our financial system, depending on the company, the financial systems could be very different. They could be like simply accounting, or they could be an ERP system or SAP. It really depends on how much money the company wants to invest in their accounting systems. Okay, so they could be really fancy or they could be very basic, but the basic understanding or the functionality of the accounting system does not change much. Okay, so we are all well versed with our debits and credits. So with any account that we have, any amounts that shows up on the left hand side are referred to as debit. Any amounts on the right hand side of that T account is referred to as credit. Although the balance of, the way to interpret the debit and the credit balance depends on what is the account that you're looking at. So with certain accounts, the debit entries would increase the balance. With the other ones, it will reduce it. Say, for example, if you debit any expenses, assets, or dividend accounts, the account balance in those accounts are going up. If you credit any of those accounts, then the account balance comes down. So likewise, so that makes it a normal balance of debit for expenses, assets, and dividend accounts. And on the other side, the normal balance is credit for liabilities, revenues, shares account, and retained earnings. So when we take the normal balance will always increase the balance in the account. Your accounting equation, this is our golden accounting equation where our asset always has to equal our liabilities plus shareholders' equity. Now, if you think of if this equation, it's coming from your balance sheet under the ASPE world. So your assets always have to line up with the total of your liability and equity. Um, any financial transaction that is recorded onto the books would eventually affect your accounting equation because all of that information will be rolled into your balance sheet. Remember, if you're looking, I'm just using the ASPE terminology for ease of use. So if you have your income statement, the income from the income statement goes on to your statement of changes in retained earnings or the retained earnings statement. And the ending retained earnings then goes into your balance sheet. So any financial transaction the business goes through would eventually sit onto your balance sheet, which means it will affect your assets equals liabilities plus shareholder account one way or the other. So for every individual financial transaction, this equation has to be in balance for every equation as well as for all the equations cumulatively. There is no way on earth that this equation would be out of balance or should be out of balance. This is our accounting cycle. So we start with the identification process. Once we have identified the transaction and we determine that this is a financial transaction we will have to account for, then we journalize that transaction. After journalizing, we post the transactions into the into the subledger or the general ledger, sorry. After posting all the transactions, we bring the information into a trial balance. Then we prepare our adjusting entries. Once your adjusting entries are prepared, then we have an option of preparing a worksheet. We'll talk about the details of each one of these steps in a bit. So we do have the option of preparing a worksheet at this stage. Alternatively, we can take these adjustments to our adjusted trial balance and then prepare our financial statements. So either we can prepare the financial statements through the worksheet approach or through the adjusted trial balance, one or the other. You don't have to do both. Once your financial statements are ready, then we close all the temporary accounts and finally prepare the post closing trial balance to ensure that all the temporary accounts have been closed. As a last step, we will look at reversing entries, which is entirely optional and that is up to the company. Identification and measurement of a transaction. So, when you're looking at a transaction, we only are concerned with the transactions that are financial in nature. Anything that is non financial, we don't worry about that transaction. Okay, not from accounting perspective. So, we only would take care of the financial transactions into play, and the item has to be recognized in the financial statement if it meets the definition of an element. Now, in lesson one, we were talking about the elements, which is your assets, liabilities, revenues, expenses. Okay, so those six categories that we were talking about, if your item or the of your transaction meets the definition of an element, then we would look at its measurability and go ahead with the recording. Okay, so if there is any uncertainty with regards to measurability of that transaction, then we will use all available information to make a very neutral decision. Remember, you always have to be neutral when recording the financial information. We cannot favor one set of users over the others. Once we have our information, once we have identified the financial information and we are able to measure it, the next step is to journalize it. That is preparing your journal entries. So we are preparing debit to a certain account, credit to a certain account, depending on what that transaction is. This is where a solid understanding of normal balances for the account would come in handy. Once we complete the journalizing process, then our next step is to post these transactions onto the general ledger. Now, a general ledger is a book. Usually in the accounting information system, this is an electronic database that summarizes and classifies the journal entries. It contains all the assets, liabilities, and equity related accounts. So capitals, revenue, expenses. Each account will have its own separate section or a page. Okay, and the accounts are numbered. So your assets, liabilities, shareholders, revenue, and expense accounts are numbered practically in the same sequence. Once we have completed the posting process, which is taking all of your journal entries and bringing it to the general ledger account, then we move on to preparing our trial balance. This is what a trial balance looks like. Trial balance is mere list of all of your accounts with their ending balances listed as debit or credit. Okay. Now at this stage, One thing you got to check is if any of the account is sitting with an unnormal balance. For example, the normal balance for accounts receivable is a debit because it's an asset account. But if you are seeing the 72,000 into the credit section for accounts receivable, then that means the journal entries posted to those accounts are incorrect. Okay, so usually a good idea to see if there are any errors. So make sure all the accounts are sitting with normal balances. The other basic idea of preparing a trial balance is to make sure that your total of debit equals your total of credit. This is just a check to ensure there are no posting errors. It does not ensure you that the data is 100% error free, but it just says that there is nothing visible. Once your trial balance is prepared and total of debit lines up with total of credit, then our next step is to move into adjusting entries. Now, adjusting entries is an internal process where we are making sure that our assets, liabilities, revenues, expenses, equity, these accounts are not overstated or understated. All right. So it's an internal process of adjusting these accounts to make sure that they reflect correct balances. So some of the examples of these adjusting entries are your prepayments, accruals, and estimations. So under prepayments, we have prepaid expenses and deferred revenue. Deferred revenue is your unearned revenue liability. Accruals, we have your accrued revenue and accrued expenses. And for estimations, we have bad debt expense, unrealized gains on losses, and OCI. Okay, we will talk more about our adjusting entries in towards the end of the topic two. Once your adjusting entries are prepared, then the business moves or the accounting process moves on to adjusted account balance, the adjusted trial balance. So the idea of trial balance does not change. The trial balance still looks the same. It's the list of all the accounts with the ending balances as debit or credit. So it does not change, but we have to make sure that our total of debit is equal to total of credit. So all we are doing at this stage is taking all of our adjusting entries and bringing them to our adjusted trial balance. Now, once your adjusted trial balance is ready, then we do have the ability to prepare our financial statements. Remember, there were two steps or the two options. One was to use the worksheet, the other one was to go ahead and use the adjusted trial balance to prepare your financial statements. So we are looking at using the option of preparing financial statements from adjusted trial balance. So the ownership structure here would determine what the equity section of your statement of financial position will look like. Okay. Generally, if you look at the proprietorships, they just have the capital accounts and drawings, but your corporations will have the ordinary or the common shares, contributed surplus, retained earnings, accumulated other comprehensive income. So, depending on the structure of these accounts or the ownership structure, we will determine how the equity section of your statement of financial position will look like. Then we move on to our closing entries. Closing entries are made to close all of your nominal accounts, which are also your temporary accounts. So basically, your revenues, expenses, and dividend. Those are your temporary accounts that needs to be closed. Now, when we take for the process of closing, you will be using another temporary account called as income summary. So the balance or the revenue will be closed against income summary, then expenses are closed against income summary. The net balance in income summary is the net income or loss, which is then closed towards retained earnings account. Finally, the last step in the closing process is to close our dividend account directly against the retained earnings. So payment of dividend would reduce your retained earnings account. If we have other comprehensive income account, which is also a temporary account, then we will close that other comprehensive income account to a permanent account called as accumulated other comprehensive income, which is AOCI. If the company is using periodic system, then do make sure to close your cost of goods sold and ending inventory account. That only applies if the company is using periodic inventory system. After the closing entries, once again, we prepare our post-closing trial balance. The whole idea of preparing post-closing trial balance is to make sure that all the temporary accounts have been closed, and the only accounts reflected at this stage should be your permanent accounts. Okay, which basically would be your assets, liabilities, and shareholders' equity accounts. Reversing entries. Now, reversing entries are reflected as a last step in the accounting cycle, but these are very optional. This depends on the business as to how they want to account for that. So, when the business says go ahead and book the accrual entries, accruals are booked in a certain period. Companies can choose to go ahead and reverse those accruals in the next period. So that is a reversing entry. Okay. And that period when the company is reversing these accruals, at that time, once they get the actual invoices, they can go ahead and record them to make their life easier. But the adjusting entries has to be adjusted one way or the other. That brings us to detailed discussion on adjusting entries, and the discussion on reversing entries practically sums up our accounting cycle. So with the adjusting entries, as we said, this is purely an internal process where we are adjusting our books to make sure that your assets, liabilities, revenues, and expenses, all of those accounts are reflecting true balances. Nothing is overstated and nothing is understated. Okay, so one of the accounts under the prepayments was a prepaid expense. So let's say the company prepaid for an insurance policy for the whole year. So at the time the insurance policy was paid, you would record the journal entry of debiting prepaid insurance account, which is an asset account, and credit the cash account. All right. Um, as the time goes, though, that prepaid insurance asset is going to be used up. The balance is not true anymore. That is where your adjusting entries will come into play. So at the end of each month, we will move the balance from the prepaid insurance account to the insurance expense account. So we are reducing the asset in this case and we are increasing the expense. The other example of this is your depreciation. Your unearned revenue is um, your liability. Okay, so if someone has paid the business in advance and the business has the liability to offer services or goods or deliver an item, then that is unearned revenue. So at the time your money was received, you would have debited cash and you would have credited unearned revenue liability or unearned revenue liability. Okay, but as the time goes, once the company has satisfied the performance obligation, they have sold the product or provided the services, whatever the agreement was, at that point in time, the liability does not exist anymore. So at that time, we need to reduce our liability and increase our revenue. So this is what this journal entry here is representing. We are debiting our unearned revenue account to reduce the liability and increase our revenue. so that we can reflect true balances in our accounts. Accrued revenue. Accrued revenue happens when the company has delivered the product or a service, but they haven't invoiced that service yet. Okay, which means it's not yet recorded. That is accrued revenue. The revenue is earned at this stage. There is no question about earning process at the time. So at the time, at the end of the year or at the end of the month, whenever the company is adjusting or booking the adjusting entries, at that time, they would set up a receivable. So they are debiting their accounts receivable for 2000 in this case and crediting service revenue for $2,000 here, right? Now, this is accruing the revenue. Let's say you did that at the end of August. All right. Now in September, you actually go ahead and invoice that. You don't want to have double booking. So what you have to be careful with is the reversing entry. So this accrual that was done in the month of August has to be reversed in September. So you will just flip this journal entry. In September, you would debit service revenue and you would credit accounts receivable to reverse it. Reversing entry is just an opposite of your adjusting entry. So whatever the journal entry was, you do the exact opposite. The debit account becomes credit, the credit account becomes debit, and we reverse it. Once that is reversed in September, then you can go ahead and invoice it to make sure that there is no double booking. The same idea applies to the accrued expenses with regards to reversal and double booking. So, accrued expenses on the other end is where the expense has been incurred, such as your, let's say, your telephone bill. You have already used up the service, but the invoice was not received. That's why it's not booked into the system yet. So it becomes an accrued expense. So at the end of the period, you will go ahead and debit your expense account and credit a payable account to set up your liability to ensure that your expense and your liability accounts have the true balances. Okay, estimation that we were talking about. So the other type of adjusting entries that we need is for bad debt. So bad debt is the uncollectible. Now, if you guys remember from your prior courses, we would have talked about accounts receivable, right? The company provides services on account. So the time between providing the services and the collection, that money sits into accounts receivable. Sometimes all of that money is not collected. So determining the amount uncollectible is the bad debt. Now, companies can either use a percent of sales approach or they can use percent of accounts receivable approach to determine their bad debt expense. Okay, there is another approach of a direct write off as well that is allowed, where it's uncommon for a business to write off any debt or write off any collectibles. Sorry, not debt, but write off any collectibles. So, based on the method the company is using, whether that is a percent of um, accounts receivable or percent of sales, then we would determine the amount of bad debt to match our expenses with the revenues that were generated in the period. So, the journal entry for this is debit to a bad debt expense and credit to allowance for doubtful account. When you're booking um, the adjusting entries, always make sure that your each adjusting entry has one account from income statement and other account from balance sheet. It has to happen. Then under our estimations, we also had our unrealized gains and losses. Now, unrealized gains and losses only come into play when we have an investment that was uh, that was recorded as a fair value investment. Okay, so FV is a fair value investment. So if we had any investment that was classified as fair value through net income or fair value through comprehensive income, so these investments um, are moved from the book value to the market value at the end of the period. So the difference in the book value and the fair value is your resulting unrealized gain or loss. The reason it's unrealized is because we are not selling the investment, but we are just making sure that the investment is reflecting at fair value at the end of the period. So your fair value through net income investment, that could be your equity instrument or it could be your debt securities. And we will be exploring this concept further in our investments chapter, which is the last one for this course. Okay. For now though, if you have any unrealized gains or losses on fair value through net income, then it will flow through your unrealized gain or loss account, which will actually impact your net income or loss for the period. On the other hand, if you have unrealized gain or loss on FVOCI investment, fair value through other comprehensive income, then that unrealized gain or loss will be housed in other comprehensive section, which will not impact your net income or loss for the period. Okay, now this is the other alternative approach that we were discussing about, which was using the worksheet for adjustment and preparation of the financial statements. Now, there is no really a set way of doing this. It's entirely a personal preference whether a user wants to use the worksheet approach or they want to use the trial balance and then prepare the financial statements of that trial balance directly. So basically, it's just a matter of preference more than anything. So this is what your worksheet looks like. It's a long Excel worksheet. You have all the accounts. We start with our trial balance before adjustments with all the debit and credit balances. Then we bring in all of our adjustment accounts and their balances. These are your adjusting entries. That gives us our adjusted trial balance. From this adjusted trial balance, then we prepare our comprehensive income. But keep in mind with your comprehensive income, once that comprehensive income is prepared, you know what your net income is. Only then you can calculate your income tax expense, right? So you will not have all the information at the go. You will have to figure your way around. So once you have your comprehensive income, all the numbers are there, then you calculate your um, income tax expense and income tax liability. Then you come back and adjust these. And then once your comprehensive income is completed, then we move on to your statement of financial position. So it is quite a process, but do make sure to know how the worksheet approach works. Okay. And finally, we have our closing entries. Your closing entries is for all of the nominal accounts, such as your revenue, expenses, and the dividend accounts. And this, so at the time of closing, as we said, there is another temporary account that comes into play, which is your income summary. So all of your revenue accounts are closed against income summary here. All of your expense accounts, which are here, are closed against income summary. The net difference in your income summary account. Okay, so 312,000 coming from revenue and 289,000 coming from expenses gives you a net income summary account of $23,000, which is income. Income summary account does not have a normal balance. It really depends on which side the balance is sitting on. If the balance is on the credit side, then it's an income. If the balance is, sorry, if the balance is on the credit side, it's an income. Yes, I said that right. If the ending balance is on the debit side, then it's a loss. I always look at the income and say, okay, if 312,000 is coming from my income and the income is more than expenses, then it must have been an income. Depends on how you want to interpret your information. Okay. Once we know the ending balance in the income summary account, then the step three is to close that income summary against retained earnings. And finally, we will close our dividend account against retained earnings. So debit to retained earnings and credit to dividend account. If we do have other comprehensive income account, then do make sure to close that against accumulated other comprehensive income. And if the company is using periodic, then do make sure to close the cost of goods sold account. That is all that we had for topic two, which is processing financial data. This is Gurpinder Gill signing off for chapter two, or sorry, our topic two, and I will talk to you guys in class soon.